understand the economy, you have to understand human nature.
This podcast is powered by Acast.
How you doing there? It is time for the podcast. We are doing part 2 of a podcast on bubbles, concentration of risk, and why sometimes when you just feel that you are at your most secure, your wealthiest, your most upbeat, is the moment of greatest financial risk. And what we're going to talk about is the concentration of risk in the United States in what is called the Magnificent Seven companies. Now, John, we talked about Joyce, Shaw, Henry, Lowenfield.
Well, we always talk about Joyce.
Harry Markowitz, okay? We talked about everyone last time, but the idea was that sometimes when risk is heavily concentrated in one area, you don't understand because of what we're going to talk about, bubble thinking, that in actual fact, you are not necessarily aware of the factors that are making you fragile, and you misdiagnose fragility and you think it is strength. Now,
so are you saying that we are in a bubble now, or America is in a bubble?
Well, I have to be very careful, John, because 25 years ago, okay, I went on the late, and I said the Irish housing market was a bubble.
Yes.
And people would say he was right eventually.
Yeah.
Okay. But it took 6 years to get there. Right?
At the time they said he's only an old bollocks.
He's only a bollocks. Do you remember that? And I was only a bollocks. Every taxi driver hated me.
Yeah.
Your man's talking through his hole. The entire financial industry hated me here. Lots and lots of people in construction, in banking, certainly in stockbroking, in all those industries said, you are pissing on the parade.
Yeah.
I was told to put on the green jersey, right?
Yes.
So the green jersey was the jersey you put on when you jump out of the airplane with no parachute. You know that jersey? It's really, really good. It's like, woo! So 25 years ago, as a young whippersnapper, I remember going on the late. It was so long ago, Gay Byrne was hosting, right? That's how long it was. So I have to be careful about
one
this.
For everyone in the audience.
And the problem is that calling things accurately is one thing, but you also have to call things timely, right? Now, in my defense, I would say, look, my job was just to tell people, hold on a second, this is going to go
The numbers
bust.
don't add up.
It was actually the feeling, John. I had just come back from living in London.
Yeah.
And I'd come back here and I remember distinctly, it was at a wedding.
Yeah.
I was at a wedding and somebody who wouldn't know a stock from a kick in the head.
Yeah.
Do you remember?
Me?
No. But somebody we know. Yeah. And he's up against the jacks after 8 pints and he's leaning.
Yeah.
He's leaning. The one arm is leaning on basically.
I'll tell you
he's
something
suddenly,
else.
and I'm in the jacks beside the urinal beside me. He's like, Macker, I'll tell you something for nothing, right? And he gave me a big lecture about buying property, right? And I just thought, oh, sweet Jesus. But it captured the mood. And for me, bubble isn't about a mathematical calculation. It's about a diagnosis of a national psychology, right? And so the reason I went on the late years ago wasn't so much that I had actually looked at all the numbers and said, this is definitely going to actually collapse. I was sure it was going to collapse, but the reason was to do with the psychology. It was more a diagnosis of a feeling than an understanding of logic. Now, the thing about it, logically then when you put the numbers in, it all made sense that this thing was going to blow. But that was 25 years ago. The thing didn't blow for another 5 years. I would say the peak of the Irish boom was probably about 2004. 2005. 2004 was the year where Bank of Ireland, it took Bank of Ireland 163 years to generate X amount of loans, right? A huge amount of loans. Can't remember the precise figure. In the following 2 years, they exceeded. So they lent out more in 2 years than they had done in the previous 130 years, right?
Wow.
Okay?
Wow.
Right. So that shows you. And
but
of course,
I do remember the phrase at the time, which was, a stopped clock is right twice a day.
that was actually, it was a phrase that I'm glad to say now was articulated by fucking bankrupt people.
Yeah.
Because most of those people go bankrupt. But it was, so I took out a huge amount of income in.
Yeah.
I remember that at the time, and you weren't popular, and it was weird. But it just was very
Not
clear.
popular.
What? Still not popular, yeah. But it was very clear. So I'm aware of this. So I'm also aware of the mistakes of calling bubbles too early. But I feel now that if you look at the States, we are in bizarre territory. We are certainly in the territory that there is an enormous concentration of wealth in a small bunch of stocks. So let's talk about the concentration, because that's the thing that should freak you out first. It's in the same way as all Irish money was in property 20 years ago. Something very similar is happening in the United States.
Right. So the big thing at the moment in the United States, Trump is about to come in next week.
Yeah.
And all the tech bros, as we said in the last podcast, are lining up to kiss his hole.
Kiss the hoop, I think is the expression.
Yes. And but all these tech bros.
And Father Joe Rogan.
And Father Joe Rogan, yes.
Right, so Father Monsignor Joe Rogan actually sounds very Irish.
Yeah, he does. Yeah.
Monsignor Joseph Rogan, right, who is now absolving all the tech bros of their previous sins, making them ready for their ascension into the Mar-a-Lago heaven.
Yeah.
And Zuckerberg being the one who is most ridiculous, because Zuckerberg was so woke and so left-wing for a while.
He was just following the crowd. Whatever somebody said.
Follow the money.
Yeah.
Follow the money.
Exactly.
So Father Joe Rogan, Monsignor Joe Rogan.
But at the moment, the American stock market is going through the roof.
Yes.
And it's been led by, as we mentioned before, these magnificent seven, all the big tech companies.
Yes.
This is the bubble.
Yes. So this is
you
the
defined
story.
it.
So basically what you have is the story is that the tech companies are mapping out the future.
Yeah.
And the future will generate enormous returns to these companies that are on the cutting edge of technology.
Yeah.
And as a result of this, they are investing enormously in AI and all sorts of various different technological innovations.
Yeah.
So all that is true, right?
Yeah.
All that is true. But I'm just going to give you a couple of figures, right? So again, the Magnificent Seven, if you're not aware, these are Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla.
Yeah.
These are these seven companies, right? Right now, the market capitalization of these seven large companies constitutes 33% of the entire S&P 500, which is the total index of all companies in the United States.
Wow.
So seven companies make up 1/3 of the total value. Number one, high concentration. Number two, that percentage is double what it was 5 years ago. So most of these companies, with the exception of Nvidia, were around 5 years ago. Even then, only 5 years ago, they counted for only 17% of the total market value. They now account for 33%. So massive change.
Yeah.
Now, prior to this, if you go back in economic and financial history, the highest share of the top seven companies in the last 30 years was 22% of the index. That was in 2000, about 2 months before the dot-com bubble crashed.
Right. Yes. Okay. Yeah.
So that gives you a sense, right? And another important thing to note is that the Americans have been absorbing in everybody else's money for a long, long time. US stocks represent 70% of the value of all stocks worldwide, which is a phenomenal disparity when you think the US economy is only 23% of global GDP.
Right.
So
what was it before? What was the average before?
It was always much lower, right?
Yeah,
it was always much lower. It was always significantly more than GDP, but not to this level. So basically what you have is you have a highly concentrated amount of stocks, which are eclipsing almost everything else. You have a huge amount of money going into them. You have a huge amount of money going into the United States. And the last time the stock market was so inflated was a month before the dot-com bubble collapsed. And even at that stage, the inflation wasn't half as bad as it is now. So that's the first thing to get your head around, which is the absolute extraordinary dominance of these companies. Now, dominance is the word you use when you think something's muscular.
Yeah.
Fragility is another way of looking at the same phenomenon when you think they could be quite weak.
Can I just say, before we get on to analyzing this possible bubble, is that all this happened under Joe Biden's watch.
Joe Biden, well, it's been happening for a while, but yes,
but the acceleration over the last 4 years has been under Joe Biden's watch, which, when we're talking about the brotocracy and Trump coming in, Trump is going to claim all this. But that's just a side note.
Well, I mean, it's interesting because what Joe Biden's presidency was defined by was the pandemic. And that was the thing that really destroyed, in a way, the Biden presidency. But the pandemic was also associated with very, very low levels of interest rates. So that was the one that propelled lots of money into these companies. It was also the pandemic was a sort of a signal, as it was, believe it or not, after the great Spanish flu of 100 years ago, was a signal for rapid innovation.
Right.
So after the Spanish flu, you had Einstein with nuclear, you had Henry Ford with cars, you had electricity, same sort of thing.
Right.
So what you see is after the pandemic has been a huge increase in innovation and technology. But you are right. Now, the interesting about Trump is that Trump is grabbing it now. If these stocks begin to fall, watch Trump drop them like a hot potato.
Absolutely.
Right?
There's no doubt about that.
So the question then is, we're highly concentrated. We've never been in a situation like this before. People who believe in these companies will say, we have never been in a situation before like this in terms of innovation.
Yeah.
And then people with older memories, like ourselves, probably say, well, hold on, I've seen this all before.
Yeah, well, we have seen this before. I mean, you mentioned before about the dot-com bubble, and in the previous podcasts about the South Sea bubble and, bubbles all over the place.
Yeah.
But let's just bring it back. What defines a bubble?
Okay, so again, I come back to the idea of Ireland 20 years ago, right? When I was in the wilderness, the John the Baptist of economics, in my loincloth, nobody talking to me, eating locust on Dunleary Pier. It's a state of mind.
Yeah.
That's the most important thing to appreciate.
What do you mean?
It's a state of mind. The reason that people buy stuff is because other people buy stuff. And the reason that is the case is because we are eminently and unbelievably suggestible. The social animal that is the human being.
Yeah.
So I've always felt that. That basically economics, as we say at the top of the podcast, it's an exercise in collective psychology.
Yeah.
It is not about maths and numbers and precision. It's about messiness. It's about bubbles. It's about feelings. It's about the human condition, right? So if you look at what defines a bubble or what is a bubble, I'm just telling you what it looks like to me. And again, if you really want to get into this, there's a great guy called Howard Marks.
Yeah.
I know you know him as a dope dealer, right?
Yes.
But he's a really good... I've quoted
Mr. Nice.
Exactly. I've quoted him before. He's got these books about, understanding market psychology.
Yeah.
He writes this great note about once every 2 or 3 months by Oak Tree Capital Management, I think, which is the firm he runs. And it's great stuff. So this podcast has taken... A lot of the stuff is taken from the Marxist view, but not the old Marxist view, the new Marxist
this is all
view.
very confusing.
Okay, right, okay. Marx and Spencer's, Howard Marx, Karl Marx, all the Marxists, right? But the first thing is, a bubble
Skid
is
marks.
always... Yeah, exactly. A bubble is always characterized by what you would call irrational exuberance, where people get irrationally exuberant, right? To borrow the phrase from Alan Greenspan, right? People begin to start thinking that nothing can go wrong.
Yeah.
That's a general rule, right? And then there's always, it's the same as happened in property in Ireland. People say, you can't go wrong with property. Right?
Yeah.
So people start to...
Bricks and mortar.
So you start to adore the asset. You fall in love with the asset.
Right.
And people have fallen in love with that.
Bad move.
Bad move, yeah. They fall in love, right? So it's almost like an adoration. You don't look at the company or the asset anymore as something with a stream of income, something that could go wrong. You just say, this is the way the world is, and I am in love with this, and I defy you not to own second homes in Bulgaria and all that carry on, right? Same thing with Meta, same thing with Apple, same thing with Tesla, right?
Yeah.
People are in love with these stocks, right? Then, of course, this creates the idea of FOMO, the fear of missing out, right? That you don't want to be the fella in the jacks at the urinal who doesn't have a portfolio of property like the fella who's pissing up against the wall, right? It's a fear of looking stupid, of not being involved in the whole thing, that they're really clever people, right? As they used to
Do
say
they
in
know
Ireland,
something that I don't know?
They used to say in Ireland, the ballsy guys.
Yeah,
Okay.
yeah.
They know something, and I have a fear of missing out. So if I can't buy a house in Aylesbury Road in Ireland, I'll buy an apartment in Bulgaria. At least I'm in the game.
Yeah.
At least I can brag with the rest of
I
the
have
lot.
a portfolio.
I have a portfolio. You
Yeah.
see what I've got, right? Okay. And of course, then that all leads to this idea that it doesn't really matter what the price is because it's still going up, right? So people chase the FOMO moment. They overpay for assets, right? It doesn't matter because we're all in this together. What I always compare it is like a group trip, right?
Yeah.
When people do yokes together, okay?
Yes, it's been many years.
Everyone drops at the same time. Everyone comes up at the same time together. And no one's allowed to wreck the bus. Don't wreck me bus, right? So it's exactly the same thing as a massive group trip, right? That's what it's kind of a narcotic. It's what I always call it's the psychology and the psychedelic nature of money, which I talk about in the book quite a bit, right?
Yes. Yeah,
Basically, imagine these are a whole bunch of people dropping yokes at the same time. That's what it feels like, right? So everyone's coming up and everyone's buzzing, right?
Yeah.
Now, of course, this is why I think bubbles are more like a state of mind than like a real sense of economic or financial logic.
Yeah.
It's an illogical, crazy, irrational, exuberant situation. And I think we are in something like this. This is like Burning Man. Look at all the tech bros go to Burning Man to take loads of drugs, right? This is like Burning Man for portfolio management.
So if we're in a bubble, I know there are various stages of a bubble.
Yes, there are.
So walk us through that, and where are we now?
So it's very hard to say. So we've spoken about the economist, a guy called Minsky, but also probably the greatest writer of all this is a guy called Charles Kindleberger, who wrote a fantastic book called Manias, Panics and Bubbles.
Right.
And it's really worth a read. In fact, it will be on the difficult dopamine course, which is coming up, which is our book club, which we'll talk about just
the Patreon book club.
Patreon book club.
Yeah.
If you want to join our book club, patreon.com/David McWilliams. It'll be we'll talk about it in a couple of minutes, right?
ABC, that fella.
ABC. Always be
closing.
Oh, I love it.
Go
This
on.
is Glengarry Glen Ross.
Exactly.
Okay.
See this watch?
You see this watch? Well, exactly. It's all that carry on, right? So let me come back. There are various stages. The first stage of a cycle is after the last collapse, because these things go in cycles. So after the last collapse, almost nobody can see a world in which things get better, right? And that's when the clever guys get in and start buying.
Right.
Then as the credit cycle begins to progress, you get to a situation where the news is good, everything's working, assets are well priced, and everybody thinks, you know what, this is entirely legitimate, okay? And that can last for years and years and years. But then you get to a situation, so if the beginning of the bubble, which is where the real money is being made, which is the place where nobody can envisage things are going to get better, except the very brave few. At the end of the bubble is the stage where nobody thinks anything can ever get worse.
Yeah.
Right?
Yeah.
That everything's going to get better all the time. That's what I mean about the mindset. And that's where I think we are in the United States. Because what people are saying is that Apple will be the number one company forever.
Yeah.
Nvidia forever, etc.
Tesla, blah, blah, blah.
And of course, then they're paying the price for that. They're paying.
But also, I think it's been boosted even further by Trump coming in, who's going to be the champion of all of this.
Because Trump's a grifter.
Yeah, totally.
I don't think that's a bad thing necessarily. I mean, maybe it's better being a grifter than a bureaucrat. I don't know, but you know what he is.
Yeah.
This is a man who's gone bankrupt many times.
Yeah.
So he understands that the credit cycle exposes bullshit. One thing about macroeconomics puts manners on people.
Yeah.
And this is the hard logic.
But he had a casino that went bust. In that casino world, when the house always wins, you gotta question that.
But then what you get into is bubble thinking, and bubble thinking is mania thinking. So basically nothing can go wrong, all that sort of stuff. And that's where I think we are now.
Yeah.
Okay. And then there's one other thing, which you see in bubbles, which is the new thing. So there's always a new thing, right?
Right, okay.
And the reason there's always a new thing is because if we're looking at, for example, housing, we can say, well, we have data on housing cycles for the last 100 years.
Yeah.
We see what happens up, down, in and out, etc. Right? We can at least say this happened before because houses are not new.
Mm-hmm. Yeah.
But AI is new.
Yeah.
Nobody has any idea where this is leading us.
And the dot-com bubble was new at the time.
And subprime, do you remember subprime? That was a new asset.
Right.
The collateralized debt obligation, they were new assets that nobody had ever dealt with before.
Yeah.
So when you'd say, well, I'm worried about this, they say, well, what would you know? Because this is new. So if you think technology by definition is always new.
Yeah.
So therefore, skeptics are slapped down as being people who don't understand. You don't understand. It's like sometimes me with the Bitcoiners. You don't understand. Yes, I do understand what it is. And I understand exactly what it is, right? But the idea is it's so new that you cannot say, well, look, this happened before. So therefore, to use that Michael Lewis expression, going infinite, it's the thinking about infinity, that basically the sky is the limit.
Yeah.
And the sky is the limit is very dangerous when it comes to money, because it means there's no price too high not to pay in order to get into this.
Yeah. Yeah.
Right? And that's where I think we are now. Now, this could take some time.
No price too high. Sorry.
So people would say, well, oh, I think, for example, Apple's share or Nvidia's share price is too high. And you say, no, there's no price too high because you've no idea where this is going.
So it's a little bit like Bitcoin crossing the $100,000 mark.
And now they're saying it's going to be 200,000.
Yeah.
Right? So there's no price too high, right? And why is that? Because this is new and you don't understand it, but it's changing the world. And as a result of that, it doesn't really matter if you missed out when Bitcoin, for example, was $10, you're still in the game.
Yeah.
So this is the FOMO idea.
Note to self, must buy Bitcoin.
At 100,000 euros, right? Our Bitcoin target for this year will be 30,000. Okay, but that's another one. We'll come back to that, right? So, but that's the idea of innovation always sparks speculation, because innovation promises a shift from what went before.
Yeah.
So always when you have innovation, it's surrounded by, or at least followed by, this character called the speculator, because innovation is the promise of the future. And the promise of the future, by definition, cannot be priced by the past because the future is going to be different. But what we're saying is no, there are cycles, there is human psychology, and there are human traits and characteristics that always elbow themselves into what is in effect a communal mania.
Yeah, but okay, innovation can spark off a big bubble. But also, as we've always talked about before, our friend Schumpeter and the gales of creative destruction will be the pin that bursts a bubble, will it?
Well, interesting. We'll talk about Schumpeter after the break, because what Schumpeter was always about is disruption. But sometimes the disruptors get disrupted. And that's what we'll talk about.
So, Mike, we're talking about bubbles and risk and diversifying and all that good stuff. And we're looking at the possible bubble that is occurring as we speak in America with the Magnificent Seven.
Yes.
But just to lead on from that, our friend Schumpeter and his relentless scales of creative destruction could well be the pinprick that will burst this bubble.
You're absolutely right. I mean, the interesting thing is, it's like all analysis is about being able to keep two or three sometimes contradictory things in your head and not get overwhelmed, right? Yeah. So, number one, Schumpeter's analysis of the way the world works means that you have to have, by definition, bubbles which generate the exuberance, which generates the risk-taking, which generates the technological breakthrough, right?
Yeah.
So we've talked about this before. In the railway bubble here, the railway mania, we were still left with railways. The .com, we were still left with the internet.
Yeah, absolutely.
Right, so,
and then the development of blockchain and all that.
All that sort of stuff. All that sort of stuff. Although, again, I'm a bit of a skeptic on that. But that's neither here nor there. But I take your point. Right? So that on the one hand, you need this Schumpeterian process to generate the innovation, right? That's the first thing. But on the other hand, what Schumpeter is all about is that if you're doing well, whatever you're doing, like whatever your business is, you don't have a comparative advantage that is persistent. You just have a temporary monopoly. You're doing well for now. So take those two things together and then take the last bit of this, which is that if you're betting on the future, by definition, it's difficult to actually quantify what you're betting on because you're betting on the unknown.
Yes.
Okay.
Yeah.
So that's why, for example, when companies can't make profit, they say, oh, don't worry, it's all about eyeballs, something like this, right? So remember they talk about this, it's market share. But market share is nothing if you're not getting paid for it. So you take all those things together and what you have is this leap of faith in the future. And that is what drives bubble thinking. And the leap of faith in the future is that whatever price you pay today for the company will be validated by this amazing performance tomorrow of these companies. Why? Because they are in the area of the economy that is being disrupted.
Yeah.
So your supposition there is that those companies will never be disrupted themselves, which kind of goes against the logic of your entire argument. That's why the idea of analysis, to be able to hold 5 or 6 contradictory things in your head at one time and not get overwhelmed. Right?
Yeah.
So take, for example, the price earnings ratio. So the price of a company is expressed in finance by the PE, which is the price of the earnings. So what is the price today as a percentage of a ratio of the earnings, right?
Okay.
So what you have, for example, on average, the S&P 500 was 16 times earnings. So that means on average, you are buying a company today and you're buying 16 years worth of its earnings, right? That is the price of the company.
Okay.
Right? That's how companies are valued by equity strategists, right? So if there is a bubble, what you will find is that the PE, the price earnings ratio, will not be 16, but might be 30 or 40, right?
Okay.
So it means that the
30
price,
or 40 years.
Yeah, exactly. So the price has deviated so much from the profitability of the company that the company is going to have to make really good profits over 30 or 40 years to make that price legitimate.
But nobody can predict that.
You see, this is why you are such a great double-hander on this podcast, because you're asking the logical questions.
Yeah.
You're not sitting in a trading room or in a hedge fund. You're saying, hold on a second, right?
Yeah.
And exactly to your point, John, if you look at the top 20 companies in the United States 20 years ago, only 6 of them are in the top 20 now.
Right, okay.
And only one of them is one of the Magnificent Seven, which is Microsoft.
And can the traders not actually see that?
Well,
or do they choose not to see that?
They don't care. They don't care.
Because it's not their money.
Exactly. But if you're actually investing for your own pension
or
for your own wealth.
Which in America, everyone is encouraged to do.
Let's say you make a few grand here in Ireland. Why not put money in the stock market? Why not actually invest? If you make a few grand here in Ireland, everyone puts money in the bank and it yields you nothing.
Yeah.
So you're actually paying the bank for the pleasure of the money that you worked to earn. So there is a reason for understanding all this stuff. In fact, I think we should get deeper into this stuff later on in the podcast in the next few months. I think it's quite interesting. But to come back to the idea, so if you were saying, like say Nvidia is trading at 30 times earnings, right? That means that you are creating a picture in your head for Nvidia, the AI company, that for the next 30 years, quarter on quarter, year on year, this company will be profitable. This will be the company that will be the market leader in AI, and this will be the company that will continue to generate profits bigger than its competition. Now that means what you're saying is this company will behave like a monopoly rather than a competitive company. Because the chances are some other company is going to come in and disrupt them. You're going to take better people, better ideas from somewhere else, okay? Now, if you take it in the aggregate, one of the reasons all the Magnificent Seven companies are going up is because the market believes that they will be the 7 companies that will be here in 30 years' time.
Right, okay.
There's no chance of that.
Yeah.
There's absolutely no chance of that. That's when I get back to the bubble thinking. Once you start to break down the logic of this, which is what I was doing years ago in the housing market, saying, hold on a second, this is the amount of money you're spending. This is the amount of rent. This is the rate of interest. It makes no sense You know, when I came up with that expression, ghost estates,
Yeah.
it's because I knew that nobody would ever live in them.
Yeah.
Now, I come back to this idea. What you see here with the price earnings ratios is that the price of these companies in America, the Magnificent Seven, are so high that everything has to go so right for these for the next, not 5 years, not 10, not 15, not 20, not 25, but 30 years.
Yeah.
Right? 30 years ago, there was no such thing as the internet.
Yeah.
As the internet.
Yeah.
Right? Forget smartphones. If you go back to
Well, the consumer internet.
1995,
Yeah.
the internet didn't exist. It was never mentioned. It comes in the late 90s.
Yeah.
Right? Okay. So my point is the world changes dramatically. And the idea that a bunch of companies are going to still be as all powerful in 30 years' time is a fantasy.
So, but this is one of the reasons I suppose that Elon Musk and Tesla, you know, are so keen on Trump's tariffs and stuff that Tesla will become a monopoly of the EV market. And then they become so big that they can buy any competition or any disruptor that comes along. Is that the idea?
That's the idea. But look, at the moment, the US car industry is 3% of the global industry.
Yeah.
The Chinese car industry is 37%. Think about it.
Yeah.
Unless something dramatic happens, cars will not be made in America in 20 years' time.
Yeah.
They just will not be made. And Tesla will be a Chinese company.
Yeah. Or there won't be cars.
Or there won't be cars.
Yeah.
But my point is, what we are looking at, and let's get back and we'll conclude here, right, is that as a general rule, most companies, on average, over all of history, generate around 7% profits per year. That's as a general rule, over every sector. Any company where the share price of that company is going up by more than 7% is becoming very expensive. Over time, the more expensive the company becomes, the more fragile its underlying base is, and the more susceptible it is to a crash. When bubble thinking reverses, what is amazing is people go from thinking, I can't believe you don't do this, to I can't believe I did that, right? So when the bubble is at its height, and we're talking about FOMO, people are saying, why don't you get in here? When the thing crashes, people look back with a huge amount of despair and anguish, thinking, how in God's name did I actually believe that shite? That's what happened here in the housing market. It's what happened here in the banking sector.
Yeah.
It's what happened here not that long ago. And it took us quite a while and lots of political fallout to get out of that. When I look at America now, on the eve of the coronation of King Trump, officiated by Monsignor Joe Rogan, and all the accolades who will turn up, it'll be like the Vatican.
Yeah.
It'll be like white smoke going up.
Yeah. The biggest crowd ever.
Right? When I see that, I think, please, please remember your economic and financial history. We leave it there.